Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Today, just how do banks influence the economy, and are we all paying for their risk-taking? We know, of course, that they take risks because they know we're going to bail them out if they get into trouble. How can we manage the role of banks in a way that is not going to penalise us all? That's today on the Debunking Economics podcast. Well, just how much of what goes wrong in the economy is down to the behaviour of banks? This is a favourite subject for Steve Keen. And how much of that behaviour is because they don't fully take account of risk? Now, of course, Steve, we bailed them out during the financial crisis. So why wouldn't they just behave the same way again?
Largely because they live on extremely short-term stimuli. I mean, this is the whole 3 months focus, the shareholder value obsession we have today, and the 3-monthly reporting cycle that people are on. There's an enormous stimulus in corporations to push the share price up as much as they can, and in banks to push out as much debt as they possibly can, because they get rewarded by the extent to which they increase the revenue base of the banks, and the revenue base is fundamentally the amount of debt they've created.
Right, but my point is that any sensible organisation would say that's all fine. We want to make sure we've got short-term gain, but we need to measure our risk, and obviously banks do look at risk. But my point is, if we've bailed them out in the past, then they will take bigger risks than they would otherwise.
Well, that's what they've done. I mean, the classic instance of that was, of course, the Greenspan put. We tend to forget that Greenspan was actually made Federal Reserve Chairman just before the 87 stock market crash. And in 87, the stock market, like, I know the Australian data better than I know the American, but it's actually more extreme, but still comparable. The Australian stock market rose by 80% between January and October of 1987. Now, when it crashed by 25% on one day, then Greenspan's response was to say, we're going to make sure nobody goes bankrupt. Now, of course, they call that the Greenspan put. And that meant you knew if you risked the business on a speculative position, then the speculative position worked out, you won. And if it didn't, you got rescued by Greenspan and you still won. Right.
So we should have just let them go bank. If they're going to, if you've speculated on something that's going up 80% and it's going to lose 25%, then you're a fool. Surely we should let you fail.
Yeah, well, that's what used to happen, because banking used to be an unlimited liability operation. And one argument I've seen in terms of restraining the extent to which banks get involved in reckless lending is to say, let's go back to the days when banking was an unlimited liability industry. So at the moment, if you and I set up a company for £1 in the UK, which is quite feasible, and we ended up being $1 million in debt because the venture didn't work, we would then pay £1 and $1 million and be out of trouble. And that's that doesn't matter that much when you've got small operations which can't create their own money like you and me, because we'll never get to $1 million worth in the first place. But a bank can create that million by lending, and this is the fact that it's a business. Once you've got a banking license, what you have is a license to lever up the equity you've got into more assets, which generate you an income flow. And if you start with say 100 million of money in the banking sector, that gives you a license to create, if you would be happy with a 10-to-1 gearing ratio, $1 billion worth of money, which you charge interest on. And if you charge like 5%, you're getting 50 million out of that. That's a 50% rate of return. So that's the great temptation of banking, that the more risk you take in that sense, the more you lever up your equity base, the more money you make, and everything's fine until people can't repay the debt you've taken out, which wouldn't matter if you had a unlimited liability, because that you'd be aware of it. But if you've got a 3-month reporting cycle and you can get bailed out and get a golden handshake, why not pump up the volume? And that's what you see banks doing during bubbles these days.
As an individual, but of course banks, looking at that the other way, banks do say, well, it's too big a risk to give these guys $1 million. But if they want to buy a house for $1 million, that's fine, because we get a house at the end of the day we can call on.
And that's what the whole hassle of collateralized lending, because again, I've been through a very personal illustration of this very recently, because what banks should do, and this is Schumpeter's vision of what banks do, is that banks should be effectively venture capitalists. Yeah. They should be assessing investment proposals, working out which ones look like they're more viable, funding those. They'll get some wrong and some right, And out of the ones they get right, they get a capital gain. Other ones that fail, they lose. Now, in fact, they don't get a capital gain, because when you lend money as a bank to an operation, you get a lien over the cash flow of the business. And if you're just relying simply upon the cash flow, you're going to get creamed. Because 7 out of 10 are going to fail. You're not going to get your interest income back on the 3 that do. You lose your principal for the 7 that fail. So there's a strong...
The numbers don't stack up. Exactly, because the very worst you're going to get out of the housing market is that you bought on a high, and maybe the housing market falls 20%, which is very irregular. And the chances that you bought on the high are pretty low anyway when you take the whole portfolio of housing investment. So it's not surprising banks are making all the money out of this.
Yeah, well, that's why they go for collateralized loans, because, as they say, if the business fails, they get the collateral. And that is an encouragement, again, to irresponsibility, and also encouragement to lend on assets, which actually inflates the price of assets. So you get a positive feedback loop coming out of the lending. So when they look at risk, and this is why they miss it completely, they look at individual risk. They look at, is your business viable compared to another? Are your house prices rising as fast as another region, et cetera, et cetera? And then they base this on the probability of you going bust as an individual isolated element in a system. The trouble is, you're not isolated. And the borrowing of money drives up the prices of the assets you have, and also drives up demand in the economy. So you get a self-fulfilling loop. So what is going on is, while they're assessing individual risk, they're not looking at systemic. And the systemic risk is what drives you into these debt bubbles and then asset price bubbles, followed by asset price collapses.
So what do governments and central banks do to try and stop this avoidance of systematic thinking? Well, first of all, they've got to appreciate that's the way the world works themselves. That's going to take a bit of time. But we'll look at that in the full-length version of this podcast. To listen to it in full, you need to subscribe at debunkingeconomics.com. Choose one of the subscription options in the right-hand side, or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen and choose a plan that will provide $10 or more support each month. That'll give you access to all of these podcasts. And we hope to see you here again very soon for another edition of Debunking Economics with Steve Keen. Thanks for listening.